Right. So I think we all know the crypto market, right? It's kind of crazy. Big wins and really bad drops. It's a wild ride. But today, we're going to go back in time. We're going to look at some of the biggest trading losses throughout history. Maybe learn a thing or two about what not to do, when you're in the markets. So think of it as a cautionary tale, but with billions of dollars on the line.
Yeah, and what's fascinating about these stories is
Yeah.
how human they are, right? I mean, we tend to think of finance as all numbers and algorithms, but behind every trade, there's a person making a judgment call, and sometimes disastrous consequences.
Yeah. Okay. So our source material for this deep dive is an article listing 12 of the biggest trading losses of all time. And just to get us started, we're going to start at number 12. And this is a story that really kind of underscores the emotional stakes that are involved in trading. It's the story of Adolf Merkel, a German billionaire who lost $1 billion
Hmm.
on Volkswagen stock in 2008.
Yeah, and you know what makes Merkel's story really tragic is that his loss was tied to a short squeeze, which is when a stock's price suddenly shoots up, catching traders who get against it, those shorting the stock, completely off guard. And Porsche was actually behind the squeeze. They were stealthily buying up Volkswagen shares. And then when they revealed how much they actually owned, the price just skyrocketed, leaving short sellers like Merkel scrambling to cover their positions, facing massive
So it's
losses.
almost like getting caught in a riptide. You think you're swimming against the current,
Yeah.
and then bam, it just pulls you under.
That's a great analogy. And for Merkel, the pressure was immense. He wasn't just facing financial ruin, his entire business empire was on the verge of collapse. And the emotional weight of all that ultimately led him to take his own life. A stark reminder that risk management goes beyond protecting your capital. It's also about protecting yourself.
Man, that's heavy stuff. Okay, so let's move on to number 11 on our list. A story that takes us back to the late 70s and early 80s. The Hunt brothers and their attempt to corner the silver market.
Oh yeah, the Hunt brothers, they were wealthy Texas oil men, and they set out to buy up as much physical silver as they could, driving up the price and theoretically their profits, right? But here's the catch. They were heavily leveraged. They were using borrowed money to fuel their buying spree. And leverage, as we know, can be a double-edged sword.
So what happened? Did their silver scheme pan out?
Not quite. When the price of silver began to fall, their creditors, the ones who lent them the money, started getting nervous. They issued margin calls, demanding the Hunts put up more collateral to cover their potential losses. Problem was, the brothers couldn't meet those calls. They were forced to sell their silver holdings at a loss, which sent shockwaves through the entire financial system.
Talk about a ripple effect. This wasn't just some isolated loss. It had the potential to take down major Wall Street firms. It really drives home the point that markets are interconnected. One person's bad bet can have far-reaching consequences. All right, let's move on to number 10 on our list, which takes us to Germany and the world of oil trading. This is the story of Gesellschaft, a company that made a big and ultimately bad bet on rising oil prices.
Yeah, Gesellschaft's strategy involved using futures contracts, which are agreements to buy or sell an asset at a set price on a future date. They were essentially saying, we think oil prices are going up, so we're locking in a price to buy oil later on.
Sounds smart, right?
Yeah. Sounds like a way to capitalize on a trend. What could go wrong?
Well, the problem is markets don't always move in a predictable way. Instead of rising, oil prices actually went down. And because Gesellschaft was locked into those futures contracts, they were obligated to buy oil at a price that was now higher than the market price. Ouch. Okay, so that's a textbook example of how market predictions can backfire, especially when you're dealing with commodities as volatile as oil.
Exactly. It underscores the importance of not just forecasting market direction, but also managing the downside risk if your predictions are wrong.
All right, so for our next story, we're heading to sunny California, specifically Orange County. This is where Robert Citron, the county treasurer, lost a staggering $1.7 billion through some, shall we say, creative investing.
Citron's strategy involved leveraging, using borrowed money to amplify his returns. And for a while, it worked brilliantly. Low interest rates allowed him to borrow cheaply and rake in profits. But when interest rates started to climb, his house of cards came tumbling down.
Higher interest rates meant higher borrowing costs, and suddenly those investments weren't looking so profitable anymore.
Precisely. The losses piled up, and ultimately Orange County had to declare bankruptcy, the largest municipal bankruptcy in U.S. history at the time.
So it's a cautionary tale, not just about leverage, but also about the importance of fiscal responsibility, especially when you're dealing with public funds. All right, let's move on to number 8 on our list, which takes us into the world of hedge funds and a firm called Long-Term Capital Management, or LTCM for short. This one's fascinating because LTCM was run by some of the brightest minds in finance, including Nobel Prize winners. If these guys could lose billions, it really makes you wonder, is anyone immune to market risk?
Well, that's the thing about markets. They can be incredibly humbling, even for the most brilliant minds. LTCM's downfall was a combination of factors, really. They were highly leveraged, which amplified both their gains and their losses. They also relied heavily on complex mathematical models that assumed markets would always revert to historical patterns.
But markets don't always play by the rules, do they?
Nope, they sure don't. And in 1997 and 1998, the world was hit by not one, but two major financial crises, the Asian financial crisis and the Russian financial crisis. These events threw those historical patterns out the window, and LTCM's models failed to adapt.
So their bets went sour. Their leverage turned against them. And they found themselves on the wrong side of a global financial meltdown.
Exactly. Their losses were so massive, we're talking billions of dollars here, that the Federal Reserve actually had to step in and orchestrate a bailout to prevent a wider systemic panic.
Wow, that's crazy. A bunch of Nobel laureates needing a bailout. It just goes to show that no matter how smart you are, you can still get caught off guard by market events. So let's move on to our next story, which involves a rogue trader at UBS. We're talking about Kweku Adoboli, a trader on the bank's Delta One desk. Now, unauthorized trading, that sounds like a recipe for disaster, doesn't it?
It certainly can be. And in Adoboli's case, it was. He was essentially making trades without the bank's permission, exceeding his authorized limits, and racking up massive losses in the process.
So how did he manage to hide this for so long? Don't banks have systems in place to detect this kind of activity?
They do. But Adoboli was clever. He managed to find and exploit weaknesses in UBS's risk management systems, concealing his trades and making them appear less risky than they actually were.
But eventually the truth came out, right?
It always does. In 2011, UBS uncovered Adoboli's unauthorized trades, and the losses were staggering, $2.3 billion. Adoboli was arrested, convicted, and sentenced to prison.
That story really highlights the importance of strong internal controls. Banks need to have robust risk management systems in place to prevent this kind of rogue trading.
Absolutely. And it's not just about the systems themselves. It's also about creating a culture of compliance where employees understand the rules and feel empowered to report suspicious activity.
Okay, let's shift gears to a story that takes us to Brazil and the world of commodities. This is the story of Aracruz, a pulp and paper company that lost billions by betting on currency movements. They were essentially trying to hedge against a weakening U.S. dollar.
So hedging is a way to manage risk, but like any financial strategy, it can backfire if your assumptions are wrong. Aracruz believed the Brazilian real would appreciate against the U.S. dollar, so they made bets that would pay off if that happened.
But their crystal ball was a little cloudy.
Yeah, you could say that. Instead of appreciating, the real actually depreciated against the dollar, leaving Aracruz with massive losses on their currency bets. $2.5 billion to be exact.
That's a tough lesson to learn. Even when you're trying to manage risk, you can still get caught on the wrong side of a market move, especially in the unpredictable world of currencies. All right, let's move on to number 5 on our list, which takes us to Japan and the story of Yasuo Hamanaka, known as Mr. Copper. He was the chief copper trader for Sumitomo Corporation. And he had a reputation for being, shall we say, aggressive.
Yeah, Hamanaka believed he could control the copper market. And for a while, it seemed like he could. He had built up a massive and largely secret position in copper futures, essentially betting that the price of copper would rise.
So he was trying to corner the market like the Hunt brothers did with silver.
Exactly. But like the Hunt brothers, Hamanaka's ambitions ultimately exceeded his grasp. When copper prices started to fall, his losses mounted. He tried to manipulate the market to prop up prices, but his efforts were ultimately futile.
So what was the fallout?
Sumitomo Corporation ended up losing a staggering $2.6 billion. Due to Hamanaka's unauthorized trading, Hamanaka himself was arrested, convicted, and sentenced to prison.
This story, like so many we've discussed, highlights the dangers of hubris, of believing you can outsmart the market. It also underscores the importance of internal controls and oversight within corporations. All right, ready for another rogue trader tale? Number 4 on our list is Jerome Kerfiel, who worked for the French bank Société Générale. He managed to rack up a staggering $4.9 billion in losses through unauthorized trades.
So Kerfiel's story is similar to Adoboli's. in that he exploited weaknesses in the bank's risk management systems to conceal his trades and exceed his trading limit. But what's remarkable about Kerfield's case is that he wasn't motivated by greed or personal enrichment.
So what was driving him?
He claimed he was simply trying to generate profits for the bank, that he got caught up in the game, so to speak. Whatever his motivations, the consequences were severe.
Societe Generale was left to clean up the mess, and Kerfield was convicted of fraud and other charges.
Kerfield's case, like Adobeli's, really underscores the need for banks to have multi-layered risk management systems that include not just automated checks and balances, but also human oversight and a culture of vigilance.
Okay, so for our next story, we're heading back to the energy markets. Number 3 on our list is Brian Hunter, a trader who lost billions betting on natural gas prices.
Hunter was a star trader at Amaranth Advisors, a hedge fund that specialized in energy trading. In 2006, he made a massive bet that natural gas prices would rise. He was essentially betting on a cold winter. That would drive up demand for heating.
So he was playing weatherman as well as trader. That's a risky combination.
It certainly is. And in Hunter's case, his weather forecast proved to be disastrously wrong. Instead of a cold winter, it turned out to be milder than expected, and natural gas prices plummeted.
I bet that sent chills down his spine, but not the kind he was hoping for.
Exactly. Amaranth Advisors was left with billions of dollars in losses and was forced to liquidate, essentially shutting down the fund. It's a classic example of how even the most talented traders can get it wrong, and how quickly fortunes can change in the volatile world of commodities trading.
Speaking of volatile, are you ready for the top 2? These are the biggest trading losses of all time, and they both involve complex financial instruments known as derivatives.
All right, bring it on.
Coming in at number 2 is Bruno Ixel, who earned the nickname the London Whale for his massive and ultimately disastrous trades at JP Chase.
The London Whale, oh yeah.
Ixel was a trader in JP Morgan's chief investment office, and he was tasked with hedging the bank's portfolio against risk. But his trades were anything but conservative.
So he was making huge bets on credit derivatives, which are financial instruments linked to the creditworthiness of companies and other borrowers. His positions were so large that they distorted the market, attracting unwanted attention from regulators and other market participants.
So he was the whale making waves in a very small pond.
Exactly, and when those waves crashed, the losses were colossal. JP Chase ended up losing over $9 billion due to Ixel's trades.
Okay, drum roll please. Number 1 on our list of the biggest trading losses of all time is Howie Hubler, a trader at Morgan Stanley. And his story takes us right into the heart of the 2008 financial crisis.
Okay, this should be good. Let's hear it. Howie Hubler.
Hubler's downfall was his massive bet on subprime mortgages. He believed that these mortgages, which were considered risky because they were issued to borrowers with poor credit, would actually perform well.
Oh, boy.
But that turned out to be a very expensive miscalculation.
You could say that. As the subprime mortgage market collapsed, so did Hubler's portfolio. Morgan Stanley ended up losing a mind-boggling $9 billion due to his trades.
Wow, $9 billion. That's more than some countries' GDP. It really highlights the dangers of underestimating risk, especially when you're dealing with complex financial products like subprime mortgages.
And what's interesting about these top 2 losses, both involving derivatives, is that they reveal a fundamental flaw in how risk was being assessed at the time. The models used by banks failed to adequately capture the interconnectedness of the financial system and the potential for cascading losses when things went wrong.
It's almost like they were driving a car looking only in the rearview mirror.
Yeah.
They were basing their decisions on past data that no longer applied in a rapidly changing market environment.
Precisely. And it raises a crucial question for anyone involved in investing. Especially in a volatile and ever-evolving space like crypto, how do you manage risk in a way that accounts for the unexpected? The unknown unknowns, if you will.
And speaking of crypto, that brings us to a concept called Pulse-Sen.
That's right. Pulse-Sen is all about taking a different approach to the high-risk, high-stress world of active trading.
So we'll dive into exactly what that means after a quick break. Stay with us. Welcome back. We've just explored some truly staggering financial losses, from a billionaire's tragic gamble on Volkswagen to a hedge fund's collapse amidst a global crisis.
It's easy to get caught up in the drama of these stories, but I think the real value lies in extracting the lessons they offer. Each loss, in its own way, reveals something about the nature of risk.
We've covered a lot of ground here, exploring a wide range of trading losses and extracting valuable lessons about risk management, human behavior, and the often unpredictable nature of markets. But I think it's important to step back for a moment and ask a broader question. If these sophisticated investors armed with vast resources and expertise, could make such colossal mistakes? What does that mean for the average investor?
That's a great question, and it leads us back to the concept of pulses in that we touched on
Yeah,
earlier.
pulls Zen, it sounds intriguing, but we haven't really had a chance to explore it fully. Can you give us the rundown? What exactly does it entail?
Absolutely. Pulse in is essentially a philosophy that emphasizes a more mindful and less frenetic approach to investing, particularly in the world of crypto. It's about shifting away from the high-stress, high-risk world of active trading and embracing a more patient, long-term perspective.
Instead of trying to time the market, ride every wave, and react to every price fluctuation, you're suggesting a more grounded approach, one that focuses on the fundamentals and the long-term potential of crypto.
Precisely. Paulson is about recognizing that volatility is an inherent part of the crypto market. Instead of fearing it or trying to outsmart it, you embrace it as part of the journey.
It sounds almost like a philosophical approach to investing, a way to find calm amidst the storm, so to speak.
That's a great way to describe it. It's about finding a balance between being informed and engaged, but not letting the market dictate your emotions or your decisions.
So what are some of the key principles of Pulse Send? Where does one even begin to cultivate this mindset?
I'd say it starts with thorough research. Pulsen isn't about blindly following trends or chasing hype. It's about understanding the technology, the use cases, and the long-term potential of the crypto projects you're investing in.
So it's about being informed and making deliberate choices, rather than reacting impulsively to market noise or getting caught up in FOMO, the fear of missing out.
Exactly. It's about taking ownership of your investment decisions and developing conviction in your choices.
What else is essential to the Pulse Zen approach?
Patience. Pulse Zen recognizes that building wealth takes time. It's about being willing to ride out the inevitable dips and corrections that occur in any market, trusting that the underlying value of your investments will prevail in the long run.
It sounds like a mindset shift.
Yeah.
Really. Instead of constantly chasing short-term gains, you're focusing on the long game, almost like a marathon runner pacing themselves for the long haul.
That's a great analogy, and this longer-term perspective can be incredibly freeing. It allows you to step back from the day-to-day fluctuations of the market and focus on the bigger picture.
So Pulse Zen is about finding that sweet spot between being informed and engaged, but not letting the market consume you. It's about finding your own rhythm, your own pulse, within the larger flow of the crypto ecosystem.
That's a beautiful way to put it. And while it might not be the right approach for everyone, I think it offers a valuable perspective for anyone looking to navigate the crypto market with more clarity, intention, and maybe even a little bit of zen.
Well, that wraps up our deep dive. We journeyed through the annals of financial history, explored some of the biggest trading losses ever recorded, and uncovered a philosophy for investing that emphasizes patience, long-term thinking, and a more mindful approach. As you continue your journey in the world of finance, remember the lessons we've discussed today. Manage your risk, do your research, and consider whether Pulse Zen might be the right path for you. Thanks for joining us on the Deep Dive.